Here's a quick explainer for an essential question number 1 in the fall of 2011. This is the one where you're opening up a new restaurant in Southeast Portland. So let's start off with question number 1 in black, which is when you're taking out a loan for some start-out costs. Taking out a loan means you have an increase in your liabilities, and when you take out the loan, you get something in exchange for it. You end up getting some cash. And please note that these two balance each other out. Your change in assets should equal the change in liabilities and owner equity, and we managed to do that. Now the balance sheet has an echo into the cash flow statement. What we have is an increase in cash from finance. Positive numbers means cash flowing in, negative numbers means cash flowing out. That's a pretty good answer to question number 1. Question number 2 in red is hiring some bartenders. So you can think of this as an increase in expenses that you have there. Expenses mean your net income is supposed to go down, and your cash from operations goes down. And that should be the connection that we usually come to. Things on the income statement will echo off into operations. Things on the balance sheet will echo off into either investments or finance, depending upon where it is. Switching over to green, you spend money out of cash reserves for some tables, chairs, light fixtures. In other words, you're taking some current assets, cash, making it go away, and replacing them with some fixed assets. And that's what the tables and chairs and things like that are. Now, remember that balance sheet equation where assets equals liabilities plus owner equity? You just handle the balancing all in the assets section, so everything works out just fine. However, you still have to deal with the echo. And the echo takes place with an investment, which is purchase and sale of assets. You bought some assets, so cash left, and so you should see a decrease in cash from investments. Question number 4, decide to raise some prices. Notice no change in sales volume. That means your revenue goes up, and that means your net income goes up, and that means your cash from operations goes up. Remember, the link between the income statement and the cash flow statement is through net income. That's the way it's supposed to work. So that should be question number 4. Question number 5, we've got some breakage going on here. Now, here's the deal. You can think of this as an increase in some expenses that are there, which decrease net income and decrease cash from operations. We're good with that. Some of you may be thinking, well, look, we've got this breakage that's going on, and that's reducing our owner equity. There's no cash changing hands. I mean, these are some possibilities. I think this one presumes more than anything. The original one, the income statement, they're actually kind of replacing these items, and it's something which is not necessarily an asset change. You kind of expect this to happen. 6, and we'll switch over to red for this one. Use cash to purchase some advertisements, so that's an expense, and customers pour in, so you're looking at a revenue change too. So let's increase your revenue from those new customers. You increase the expense because you have to pay the ads there, and this gives you an ambiguous effect on net income, which follows over into an ambiguous effect on cash from operations, and that should be a pretty good answer to number 6. 7, going in green, let's make some payments on a loan. Kind of the key ones we wanted to get here is that when you make a payment on the loan, you're giving them some cash, so your assets are going down, that's the cash part, and it's balanced off by a decrease in liabilities. It's also cash leaving the business, and it's cash leaving the business through finance. So it's borrowing and lending is what we're doing. Now that's kind of the essential part, and that's what we should be looking at if the loan had no interest. Remember, it's also possible for things like, oh, there's an interest expense here, and this reduces your net income and so on down the line. But as long as you got this connection between the balance sheet and the cash flow statement, we're pretty good with that. And then finally, the last one, item number 8, a food order shows up with an invoice. So what we've got going on here is that we've got an increase in your inventories. At the same time, that invoice that's right there means we have an increase in your liabilities that are also increasing. So we're like buying something, and at the same time we're borrowing money is a nice way of thinking about it. So normally when you buy something and there's no invoice attached to it, you go, there's a decrease in cash from operations. So if you split it apart, that's what should happen. At the same time, when you're borrowing money, you see an increase in cash from finance. And that's what happens over there. So there's no net change in cash, but there are these two separate parts, an inflow and an outflow. And that should be the explainer for the essential question about the new restaurant in Southeast during the fall of 2011.